Hey everyone, and welcome. Today, we are diving deep into something that every single paid tax preparer has to get right: IRS due diligence. And let me be clear, this isn't some friendly advice or a best practice, it's the law. And getting it wrong? Well, it can be seriously expensive. So, let's just start with a number: $2,600. What do you think that represents in the world of tax prep? Take a guess.
If you were thinking penalty, you're definitely on the right track. But here's the kicker. That isn't for a whole season's worth of mistakes. Nope. That is the maximum penalty the IRS can hit you with for due diligence failures on just one tax return. And as you're about to see, that number can stack up scarily fast.
So, what in the world is due diligence really? Well, you can think of it as a set of non-negotiable legal requirements. It's the framework the IRS mandates you follow to make sure your clients are actually eligible for the tax benefits they're trying to claim. It's all about verification.
Now, you don't have to do this for every single line item on a return. These special rules get triggered by 4 very common tax situations. So if your client is claiming the Earned Income Tax Credit, the Child Tax Credit, the American Opportunity Tax Credit for Education, or they're using the Head of Household Filing status, ding, 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 your due diligence alarm bells should be going off. So how do you get from zero to that scary $2,600 figure? It's not one big penalty. It's actually a stacking system. The IRS can assess a separate $650 penalty for each of those 4 triggers. So if you miss the due diligence for EITC, that's $650. And if on that same return you also miss it for head of household, bam, that's another $650, and you're already at $1,300. You can see how one client file can turn into a huge headache. Okay, so that's the problem. How do you avoid it? Well, the good news is the IRS isn't trying to trick you. They've laid out a really clear compliance blueprint. It all comes down to 4 basic rules that are designed to protect you, your practice, and your clients. At a high level, the whole process boils down to these 4 key actions. First, and this one's the most important, is the knowledge requirement. After that, it's about the mechanics, using the right worksheets, properly filling out and filing Form 8867, and then keeping all of your records for 3 years. Let's break those down. All right, rule number 1, the knowledge requirement. This is the absolute foundation of everything. And notice that very careful phrasing, or have reason to know. That's huge. It means you can't just accept information at face value if it seems fishy. You can't turn a blind eye. If something a client tells you doesn't add up, you have a legal duty to ask more questions. And that, of course, leads to the million-dollar question, doesn't it? How on earth do you prove what was in your head a year or 2 ago? How do you show an IRS auditor that you did your job and had no reason to doubt your client's story? Well, the answer is all about your process. You prove what you knew by asking good, probing questions, not just simple yes or no ones. You follow up on things that seem inconsistent. And, critically, you document everything, contemporaneously. That just means you write down your questions and the client's answers as it's happening. Those notes are your absolute best defense if an audit ever comes. The other 3 rules, honestly, you can think of them as the mandatory paper trail that backs up rule number 1. You have to use the official worksheets to run the numbers. You have to attach Form 8867, which is basically your due diligence checklist, to every single one of these returns. And you've got to hang on to all of it for 3 years. It's about creating a bulletproof record of your work. Okay, so what happens if the IRS thinks you're dropping the ball? They don't just raid your office. They actually have a pretty clear enforcement ladder they climb, step by step. This whole process is designed to escalate. It usually starts small, at the low-risk end, with what they call educational letters. It's a gentle nudge. If their system keeps flagging issues with your returns, things can move up to warning calls or even in-person visits from an agent. The next step up is a full-blown formal audit. And at the very top of that ladder, That's where you face those big penalties or even an injunction, which could stop you from preparing taxes altogether. And here is a really important insight. If you get one of those early letters, please do not panic and do not ignore it. It is not a punishment, it's a warning shot. You should see it as a gift, an opportunity to go back, review your process, and fix whatever is wrong before it becomes a massive problem. Ignoring it is the worst thing you can do.
But let's play this out. Let's say things do escalate, and one day you get letter 6199 in the mail. That's the official notice that you've been selected for a due diligence audit. Yeah, it's a serious situation, but there is a clear playbook for how to handle it.
The audit itself is a very structured thing. So you get the letter and your first step is to call the agent and schedule the visit. When they arrive, they're going to interview you about your process and they'll pull a sample of about 25 client files to review. After they're done, you'll have a closing conference where they tell you what they found. And at that point, you'll know exactly what's on the table and what you need to do next.
So at the end of the audit, you come to a fork in the road. Path 1, you agree with their findings, you'll sign the report and work out a way to pay the penalty. Path 2, you think they're wrong. You have an absolute right to appeal their decision. And this is a big but, you have to move fast. You only have 30 days to get a formal written appeal submitted to the IRS. We have covered a lot. The rules, the penalties, the audit process. But if there is just one thing I want you to walk away with today, it's this one simple golden rule. The single most common and most expensive mistake a preparer can make isn't some complex misunderstanding of the tax code. It's just simple complacency. It's assuming that because you've done Mrs. Smith's taxes for 10 years, you know everything about her life. But life changes. People get married, they get divorced, kids grow up and move out. Making assumptions is the absolute enemy of due diligence. And that leads to this non-negotiable truth. Due diligence is not a one-and-done thing you do for new clients. It is an annual requirement for every single client claiming one of those 4 benefits every single year. It doesn't matter how well you know them, it's the law. So in the end, your client files are so much more than just numbers and forms. They are the story of your professionalism. And the final question you have to ask yourself is this. When an IRS auditor opens up one of your files, what story is it going to tell? Will it be the story of a diligent professional who asked the right questions? Or will it be the story of a costly mistake built on assumptions? That's a choice you make with every single return you prepare.